How is the landscape of multifamily real estate evolving in Canada, and what are the latest strategies for wealth creation in this sector? Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. Crombie Real Estate Investment Trust, a name synonymous with retail properties across Canada, is making waves with its strategic shift towards the multifamily sector. According to a recent article by Steve McLean on renx.ca, Crombie REIT is leveraging its substantial portfolio of grocery and drugstore-anchored shopping centers to tap into the lucrative world of mixed-use and multifamily developments. Donald Clow, the president and CEO of Crombie REIT, highlighted this shift at CIBC's real estate conference. Clow emphasized the potential of developing up to 6,500 residential units, a venture that could represent approximately $3 billion in residential opportunities. This move is primarily facilitated through the acquisition of the Safeway portfolio in 2013, along with other strategic acquisitions. Clow pointed out the unique advantage that Crombie possesses. Many of their properties are situated in prime urban areas with significant air rights available for development. These are grocery store sites with ample parking lots, often surrounded by high-rise towers, making them ideal for mixed-use projects. While Crombie's roots are deeply planted in retail, the shift towards multifamily is driven by a long-term vision for wealth creation. Clow stressed that building a substantial rental apartment portfolio is more beneficial in the long run than the transient gains from condominium sales. For instance, Crombie is embarking on a project on Davie Street in Vancouver, estimated between $150 million to $170 million, aiming for a 6% yield. The potential for annual rent growth in Vancouver apartments stands at 3%, a promising figure compared to the 1.5% annual rent growth in their Sobeys grocery stores. This strategic pivot not only aims to increase cash flow growth, but also positions Crombie as a formidable player in the multifamily sector. Initially, Crombie is focusing on developing 19 sites across Canada, including 9 in Vancouver and others in Calgary, Toronto, and Halifax. These sites are chosen for their high land value, which exceeds the current built environment. Clow mentioned the possibility of acquiring additional grocery store-anchored sites to expedite development timelines. Crombie REIT's strategic move into the multifamily space reflects a broader trend in the real estate industry, where long-term value and sustainable growth are prioritized over short-term gains. As Crombie continues to explore these opportunities, it remains poised to redefine its presence in the Canadian real estate market. Solaris Estates LLC, a key player in the national multifamily housing sector, has announced an innovative direct-to-investor capital raise. This new offering provides accredited investors with direct access to institutional-grade real estate opportunities, all while furthering the mission of supporting affordable housing in underserved communities across the United States, as reported by Globe Newswire. Located in Miami, Florida, Solaris Estates is known for its specialization in revitalizing underserved communities. By eliminating traditional intermediaries, the company's direct investment platform offers increased transparency and alignment for investors seeking opportunities in stabilized assets. This strategic move enables investors to participate directly in Solaris's mission-driven projects without the layers typically associated with brokers. With a substantial portfolio exceeding $500 million and over 4,500 units under management, Solaris Estates has established a solid reputation for transforming distressed housing into thriving, resilient neighborhoods. Their vertically integrated operations allow them to maintain control over every phase of the process, from acquisition to property management, ensuring consistent performance and tangible community impact. The new offering is particularly appealing to accredited investors who are looking to engage in institutional-grade real estate ventures that are generally reserved for large funds. Solaris's approach is designed not only to deliver cash flow and long-term value, but also to fulfill its mission of building safer, stronger communities. This aligns with the growing trend of impact investing, where financial returns are coupled with positive social outcomes. Founded 25 years ago as a family-run business, Solaris Estates remains committed to integrity, accountability, and community transformation. Their vertically integrated platform underscores their dedication to acquiring, renovating, and managing multifamily housing with a focus on long-term value and community impact. This initiative not only opens doors for investors, but also reinforces Solaris's role as a catalyst for positive change in the real estate industry. In an exciting development for the multifamily sector, Langdon Park Capital and Standard Real Estate Investments have acquired a significant apartment property in Azusa, California. This 84-unit community, now rebranded as Langdon Park on Arrow, is set to operate under a long-term affordability structure, providing much-needed housing solutions for working families. According to Amy Works from Business Online, this acquisition marks a strategic move to enhance the resident experience while maintaining affordability, a balance that's often challenging to achieve. Located just 25 miles east of downtown Los Angeles, the property features a variety of 1, 2, and 3-bedroom apartments. The new ownership group is planning modest renovations aimed at improving the living conditions without causing displacement, reflecting a thoughtful approach to community development. This is a prime example of how strategic investments can lead to enhanced living spaces while preserving affordability. The acquisition was backed by a joint venture securing equity financing from the Community Preservation Corporation. Additionally, a Fannie Mae loan, arranged by Walker and Dunlop, played a crucial role in facilitating this deal. It's heartening to see such collaborative efforts in the real estate sector, where partnerships between investors and financial institutions can lead to sustainable developments that benefit communities. Notably, the property will benefit from a welfare tax exemption through the California Municipal Finance Authority, thanks to the active participation of Housing on Merit, a nonprofit serving as the managing general partner. This tax exemption is a vital component that aids in maintaining the affordability of these units, ensuring that the financial benefits trickle down to the residents, reinforcing the mission of supporting working families. This acquisition by Langdon Park Capital and Standard Real Estate Investments is a testament to the growing trend of aligning financial returns with positive social outcomes. The focus on long-term value and community impact is becoming increasingly important in today's real estate landscape. It's encouraging to witness such initiatives that not only aim for economic success, but also prioritize community well-being. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.